Welcome back to K-Ratio's Weekend Preview. I'm Kyle Lintner and I'm here today to provide actionable insight for the future, not recap the past. In this week's episode, volumes and rejections have stopped moving in the same direction, and that phenomenon looks like it's here to stay. We'll break down what that means for you this week, but first let's take a look at where the freight market currently stands. With the holiday season comfortably behind us, the National Outbound Tender Volume Index has found a home in and around 14,000 since January 8th, a shockingly high number. For perspective, if we strip out all holidays, the OTVI has not been below 13,000 since July 26th. 2020 strength has undoubtedly carried over into the new year. Despite volumes returning to where 2020 left off, rejections by way of the National Outbound Tender Reject Index have not, and remain flat at 22%, though well above the previous 2 years, which were both at 8% this time of year. There are two major takeaways from this. First, this gives us an accepted tender rate that implies 18% volume growth year over year, which is truly astounding when you stop and think about it. And second, volumes are very strong, but cancellations are somewhat easing. That typically means price is stabilizing and/or in balance. For more on that last part, a quick check of national spot rates as reported by Truckstop presents a picture that fits so far. Rates pulled back from their extreme holiday spike of $3.22 to $3.04 a mile, a drastic 18-cent drop, but still $1 more than last year at this time. The broader picture here is that since passing $2.80 a mile on September 1st, the market has not dipped back under that, despite testing lower twice. We seem to have found a floor in spot rates, but for the rest of the story, we need to check in on the relationship between spot and contract. DAT's latest numbers show our slight pullback in spot rates from $2.53 to $2.46 a mile, which cuts the spread between the two in half, now down to 7 cents. That is the narrowest spread between spot and contract since these two inverted back in August. We have not quite arrived at the turning point in the story just yet, but we are getting close. Whether that's mini bids or moved up RFPs, contract rates are closing in on spot rates. The upward pressure on rates will not disappear until contract surpasses spot, but from here on out, the amount of loads going spot will begin to dwindle. Regardless of that drop in spot volumes, however, will not be a drop in spot rates, as contract rates now up 13% year over year will keep a firm floor underneath them. Only a drastic reduction in volumes would bring a steep drop in spot rates, and that isn't happening anytime soon. Fans of the show know we usually bang the drum for LA at this point, but as the other charts for the ports of New York, New Jersey, Charleston, and Savannah show, the surge in import volume isn't isolated to Southern California. Partly increased U.S. consumer spending, mostly inventory rebuild, all positive for freight volumes. The amount of cargo hitting U.S. shores is astonishing, and it has to go somewhere and on something. While we do not know how long this will last, we do know this strength in volumes will not let spot rates dip below contract, even as we reprice those higher. What does this mean for freight this week? Carriers, LA is still the place to be. December import volumes were the highest on record. The next 3 weeks are forecast to be 50, 70, and 160% growth year over year, and there are still 32 vessels waiting to unload. Brokers, last week we highlighted the parabolic move in reefer rates. Again, more bad news this week. The spread between spot and contract there has widened out to 18 cents after closing 2020 at 13 cents. Reefer isn't getting any better, and produce season is just around the corner. Price accordingly. Shippers, something there for you as well. This is an example of the perfect opportunity to run a mini bid or get some rates on file to temporarily hold you over until the annual bid cycle. To think that reefer rates will come back to earth before produce season even begins is very unlikely, probably damn near impossible. In fact, national reefer rejections compared to dry van are out to their widest margin since the peak of 2018. To stay current with everything freight, follow us on LinkedIn, or for more information on all of our products, including our award-winning freight intelligence platform so your margins don't end up where they are today, check us out at k-ratio.com. Please stay safe, and thank you all for watching.